The following is a presentation of TFNN. The Tiger Technician Hour with your host, Basil Chapman. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, Basil Chapman.
Hi everyone, Basil Chapman, Tiger Technicians Hour. My pleasure to be here Monday through Friday, 11 o'clock till noon. And I had the pleasure of sitting with Tommy Jr. The last hour. Tom's out and he'll be back later tonight, I guess. Be back tomorrow morning, in fact, for his show. So the Dow's down 211 at 18,113. S&P's down 29 at 2129. I just want to show this chart. This is the 120-minute E-mini chart, and there's a pattern that I call the Chapman wave single leg up syndrome. Why do I call it a syndrome? Because it's an emotional characteristic in response to something that happens. News, earnings, Fed mentioned, this was a Fed mention yesterday, that powers the move up, but it doesn't have any veracity, it doesn't have any technical underpinning. And that can fail. Now, sometimes there's just a nominal little peak for A and then it goes to B, but the thrust is really like a single leg up to the upside. My contention is if it breaks 1/3 of the way, watch out, because 50% is quite easy. But if it breaks 2/3 to the downside, there's a real good chance it's going close to the low that started the whole thing. And therefore, you've given back everything. It's an A that fails. In this case, it'll be a B that fails. All right? So the E-mini is down 29 at 2122. That's a lot. And yesterday was a spectacular move going from the 21. No, it was just under. It was 2100. Yeah, the 2100 level spiraling up. This is 2100 going to 2156. 56 points. That's huge. Except that now we're down 30. And overnight we were down. So this is very important. This is just proving once again that when a trend is in place, it stays in place. The moment that the trend changes, no matter what happens, until there's a trigger to really decisively change the trend back to what it was, it'll remain, in this case, to the downtrend. So here's what I was just talking to Tommy, and this is what I call the sandwich effect. If there's a whopping red bar followed by a green bar, and the bodies of the candles are pretty close together, you see the wick is below, but the body is right inside there. And in this case, you're followed by another strong directional change. That inevitably will say that if you take out the left side low of importance, in this case 2100.25, you'll be going down even further. Not you, but whatever it is we're following. That's number one. Number two is, within the context of the markets, I've been talking about this arch formation in the weekly chart, in the daily charts. Look, the Dow arch formation. Let me go here. The Dow arch formation. This is where I go show my subscribers to my opening call every day. We discuss it in great detail. The technicals, the MACD was great on July the 20th at peak C. It was much weaker when it went to a new all-time high at 18,668 on the 15th of August. And look, I didn't take the top at 18,554. I went a couple of bars later to get that doji there and the deflection lower in the stochastic and the MACD. And now the technicals are even way worse. And that's suggesting that there's a real good chance that this downtrend line, which held perfectly, which is now at around about 17,980, if that's taken out, the next area of support will be right there, this 17,850s. But my target, actually, the next downside target is 17,713. That's the low that was made back on the 6th of July. There's a left side, right side price time match, which says by the 26th of, I think it'll be much sooner, but by the 26th of September, we should be testing that level. All right? So On the upside, you've got tremendous resistance at the 9-period exponential moving average, the maroon colored at 18,332. Let's go on, and we're going to cover a couple of other things. I just want to do this because I'm looking at it right now. I'm liable to forget. There's a pattern that I call the H pattern, nicknamed the dreaded H, because when it takes out the left side low, it just goes much, much lower. And in my CD, Introducing the Chapman Wave Methodology, 476 slides, 27 or something like that, chapters, and a glossary and exercises with the answers. This dreaded H pattern shows you right here that when you come down, you got the lower, the back of the H, then you get the arch formation that makes the lowercase h. And when that left side gets taken out, it goes lower. And when the left side again got taken out, and then eventually it can get a very large one, and it could even turn into an M, a lowercase m, like a little worm formation. All right, so let's get out of that, and let me show you how many times it's already done that. There's the all-time high at 18,688. It makes the H pattern, makes another one, makes another one, and now it hasn't even had strength to make an H pattern, right? So this is very important. So let's run the numbers here. We've got, as I said, Dow down 200. Now it's down 241. Wow, what an acceleration. And for us in my opening call, we went short on August the 12th, the day before the all-time high, because it was peak D confirmed. And most importantly, we have quite a number of short positions. Some were taken out. We've tried to add to, we have added to one in particular. Now let's go on. So now S&P, SPX, how much time? Yep, I've got time. S&P, let me do this. S&P is down 31 at 21.27. The QQQ is down 115, down 127 and 115. Gold is now, what was it, only up $1. Now it's up 3, but it's still quite weak at 13.28. TLT, that's bonds, down 49 cents at 135.10. The weekly is in the sell signal to sell mode. It's actually in sell mode, so yields should go higher. And we've got crude oil. It was down before. Now it's still down. It's down $1.31 at 44.98. And I think I've covered most of those things. I want to go to Scott in Safety Harbor. Scott, how are you?
Well, Basil, the market fooled me for a change here. POT, I mean, went up to almost 18 on rumors of a merger.
Right.
They get confirmation there is going to be a merger, and it goes down. So, little confused here.
So there are a couple of things. Remember, we spoke about the pattern in potash, and what I'd said is, well, first of all, that spike to the upside was really news-related. This has the characteristic of what that pattern I was just talking about, the single leg A, happened to be D, peak D, but that very big spike on the 29th was on the 30th of August that had all the news and everything, the characteristics of a D. And one of the things that we had spoken about is that I said, yeah, we could be going from the lower level in potash, POT is the symbol, trading at 16.10, down 66 cents, and then we could go towards the upper band, but I really thought that there was a strong possibility that the H pattern that goes to a lowercase m pattern could continue, and I don't see any reason to change that. One thing that did change is that because it was acting quite well when we were looking at it, it was up in the 17s, is that if it managed to squeak above the high of the 2nd of September, 1842, I could have drawn in a cup formation. Hey, can you hold on a minute and we'll be right back?
Hold on about.
Yep, we've got Scott in Safety Harbor, Basil Chapman, Dow's down 240, S&P's down 32. We'll be right back after these important messages.
If you're looking to discover a new financial resource and diversify your financial portfolio, consider the new Market Safe Focused Commodity CD from Everbank. This 5-year U.S. dollar-denominated CD gives you exposure to 6 equally weighted commodities, including gold, silver, copper, nickel, soybeans, and sugar, in one powerful CD. With annual pricing caps of 50% per component, you could earn up to a 50% upside payment at maturity if the commodities increase in value across annual pricing dates. And should the opposite occur, your principal capital is 100% protected. Keep in mind, returns are based on CD performance. There is no annual percentage yield or periodic rate of interest on this index CD. Don't miss out. Take advantage of this financial resource designed to grow with the times. The October 13th funding deadline will be here before you know it. So hurry over to everbank.com/TFNN for the CD's term sheet and other important product details and disclosures. Once again, that's everbank.com/TFNN. This advertisement is sponsored content. Everbank is a member FDIC.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com. The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN and you'll find the Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
Basil takes your phone calls. Now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Hi folks, we're back, and Basil Chapman here, and I'm on with Scott in Safety Harbor. Scott looking at potash, and he's done fantastic with it, and this is the one time that I think it just gave you a little bit of a smack on the nose, that's all.
Yeah, I mean, the charts usually apply pretty well, but, you know, I call them, you know, level one events. Something like a merger kind of usually, you know, trumps the chart, you know, because it does, I hate to keep saying that. and the, you know, it just puts the charts on hold temporarily till it settles back down into a pattern again.
Yeah,
but
so
it
in the
didn't happen
meantime,
with this. I mean, why is the merger pushing the stock down when it's raised substantially the value of POT? It just doesn't make any sense at all.
oh yeah, but well, we're talking two different things. One is we're talking about a spike on the rumor, and then the news itself kind of sees it settle down. The other is that the chart formation in the month, you remember what I said in the monthly chart still looks terrible until I see potash trading in the 21 to 22 area over a 2-month period using the 20 as a base. I have to consider that it's just going sideways. There is a chance, and that's the reason why for my subscribers, I decided we wouldn't go into back into the commodity area. It was just getting too. I just had no confirmation that there was real strength in any of the upside spikes.
I understand. Let's switch gears here for a second, Basil, and go into the VXX. Is it time for the VXX?
You know,
because my feeling is this thing with Hillary is, you know, people still don't get this. A lot of people don't understand. Trump's a New Yorker, but he's actually terrible for the stock market. So, you know, Hillary is better for the stock market. So in light of what's happened, I think it's my opinion that's why we're having the volatility today.
So, okay, let me just I'm going to do two things. Quickly to the VXX at 40.42, Now, of course, your risk is that there could be, I've got a technique that I use. It's called the Chapman Wave Trin Gauge. It worked fantastically, indicating that yesterday, today, the Dow should be negative with the reading that it gave yesterday, and the reading that it's giving right now suggests that within 2 days, we should get a sudden upside spike in the 9 to 11 points in the S&P, but it could come from lower down, and all it says there should be an upside spike, but then it can go back to the trend. So yeah, right now at this particular point, you've got to be a little bit careful, because I think we're becoming just intraday on a very short-term basis, a little bit overbought emotionally, that is on a sentiment basis. So I'm going to suggest to you, if you are interested, because I think we are going to make lower lows and lower highs for a little bit longer, if the VIX at VXX, which is the iPath S&P 500 VIX short term, if it is at 40.43, you could have got in this morning in the 37s, but now that it's 3 points higher, I'm going to suggest that you're either going to miss it or you're going to get a really good opportunity, and that opportunity will be closer towards 38.50 than it is now. I would prefer to see a sudden spike, have the VIX index suddenly collapse just on a short-term basis, but it's going to take a sustained move to the upside about an hour and a half that looks like it's like yesterday. There's a sudden spike for the VIX to actually pull back those 2 points that you really need right now. 2, I'd prefer even more, because if it just pulls back because the market is spiking and it's just short-term, that's not going to do it. You need to see a sustained move. A reason why I say that, this is only leg A in the weekly chart and in the VIX, in the VXX. And the reason why I'm looking at it positively is to say that I believe that it should at least make a B. It's done that a number of times. It made that B back in July when the market
made the July 20th. So would you hold off on creating a position right now, or would you wait to get into a position?
If you are talking about creating positions, then I'm going to say at 40.38, because my eye says there's a pretty good chance it's going to go to the 43, 44s over a period of a week or so, which is nice. I'm going to say that you could just nibble on it right now, 40.44, just in case we actually double down on the day. We haven't had one of those for a very long time. That would be whatever the price is at noon. I used to have a technique that said, whatever the price is at noon.
The news is going to carry over from today to tomorrow, but the silliness of this whole thing is this. It doesn't matter about, Hillary or health, because in light of something that would completely be catastrophic, other than that, it just more motivates her supporters by other people saying she's not, and you know what I'm saying? By people saying she's not in good health. If I was a Hillary supporter, I'd say, well, the heck with you. I'm going to get me and everybody in my family to vote now. I mean, that's just human nature. So I don't think she should enter into this whole thing. They're both in perfect health, considering their age and everything. And I don't think it's going to be a problem.
So let's do this, because I was going to do a little politics talking today, but I've decided this is a very important moment. It's more important to be looking at the technicals in the market. I love to do the when people ask me what I do, I say I do an X-ray or an MRI of the market. That's what I do. So I'm looking at this, and I'm suggesting to you that if you want to just start a position right now saying, hey, I might be buying at the high of the day, but I think it's going higher, my preference would be just...
Like a 20% position off of 100?
I do a 15% position. What I would prefer is to have the safety of going under 39. Really, I don't know if you can get it, but have patience this week. If you can get it at about 38.30, I would much rather. That's the position that gives you a better risk to reward. But I suppose you could do 20%, and then say the next 20% is on a decline down to the 38.5 area.
I think I'm going to go with a 15% now, and so I won't feel bad if it goes to 43, 44. But then it still gives me plenty to go down with and bite it down all the way to the bottom.
Scott, I'm also going to mention, because you haven't traded the VIX as much as you've traded other stocks.
No, I don't know the VIX at all. I really don't. I'm working on emotion right now. I'm working on emotion. I do not know the VIX.
Then you have no choice. You might miss a most fantastic move, but I'm going to say stay with the 15%. Get to understand it intraday. it'll take you no more than 2 weeks to really get a feeling for the VIX under these conditions, and then you're going to have it for the rest of the year in your system. So don't think you're going to get it all in one swoop. Have patience. I think 15%. Watch it, follow it. You could even just trade 15%. Even if this is the move that you really want to be in big, it doesn't matter. This is a learning process. You know that there's always time. There's always another trade. I think 15%. Don't forget, I've got that. My Chapman Wave trend gauge is suggesting there could be a sudden up spike that'll fool everyone before it comes back down again, and that could happen within 2 days. So just nibble on it, get a feel for it, watch it during the day, and you can even try to intraday trade it to get an even better feeling for it. But don't get carried away. Use it as a learning
You're right, Basil. Like I always say, it's a new relationship. Just, take it slow. Don't pull out any wedding rings.
You're still courting the VIX, that's all.
Yeah, exactly. Thank you so much.
Good luck. Thanks for calling, and good idea with this. Folks, we'll be back. Basil Chapman, Tiger Technicians Hour, Dallas down 229. Come back a little bit, and I'll be back. I want you to talk about a couple of other things here. I'm going to move over to yields, and we'll talk about that as soon as we come back.
Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Techno-Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com. Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
TFNN is excited to offer a brand new piece of market scanning software unlike anything the industry has ever seen. John Logan and his team have spent years developing their market profile tools to finally be able to release the TAS Profile Scanner Plus. And right now you can get a 2-week trial absolutely free just by visiting TFNN.com and providing us your name and email address. The TAS Profile Scanner Plus is the premier market profile based scanner in the industry. Powered by the acclaimed TAS proprietary algorithms, this feature-rich scanner is a standalone desktop software that instantly filters over 2,500 global financial markets such as stocks, ETFs, commodity futures, and Forex. Within 3 minutes of signing up, you can have the software downloaded and running on your computer with a complete roadmap of market indicators and inflection points to trade off using the TAS Profile Scanner Plus. Sign up today and try this amazing piece of software by visiting TFNN.com.
Tiger TV is an exciting way to experience TFNN programming. See high-definition video giving you crystal clear charts, as well as seeing some of the faces of TFNN's highly acclaimed financial experts with crisp, full-fidelity sound. Catch Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, Larry Pesavento, Think or Swim, David White, Andy Hecht, and Daryl Martin in crystal clear, high-definition audio and video. Tiger TV, exclusively at TFNN.com. This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Hi everyone, Basil Chapman. So we're back, and the Dow's down 247. This is very interesting. You see, leg B has begun in the 30-year T-bond yield, the TYX. That's the white one. The brownie color one is the 10-year T-note. It's in leg C. But look at the little cluster pattern. This is not a huge move at all. This is like a tentative. Maybe it's the start of something bigger. But at this moment, it's one of the smallest moves that it's had in a long time in such a short period of time. Look at the 5-year note. Leg B hasn't gone to C yet. And also, tiny little move. Well, there are a couple of things I look at. Let me squash this, and I'll show you something. This was back in June of 2007, right there, 54.08. That's 5.4% for the 30-year. 30-year right now is trading at 2.42%, half. Most importantly, what we're looking at, you see the little cluster formation there, and a little cluster formation there. And that's where the yields are getting closer and closer. You see the cluster formation right there where they were absolutely almost together. That is as a price point. That how can I explain? The distance between them was very, very close. And when you got down at the bottom here, although they all made the ictus, the bottom at 11.85 for the 30-year, it was very important that there was a big spike, and they all did it together, but they weren't very close together. This is the closest they've been in a long time. Now, if I had to measure it in price, it's the 5 and 10-year that are the closest. The 5 and 10 have moved quite a bit away from the 30-year. You see, when I look at it right here back in 2011, you see the distance between the close at 26.94. What was that one? That was 16.96 on the 10-year and 7.71 on the 5-year. They are equidistant and quite far apart. They're getting closer and closer. So yield curve, a whole bunch of things are coming into effect right now. But most importantly, I love to just look at the price, and I'll make it real simple. I like to draw trend lines. Unfortunately, in this case, if I draw this trend line right here, if I just continue this trend line over there, it's really very, very much higher up. So it doesn't give us that much information. I want it shorter term. So the 27.14 would be, 27.20 would be a breakout for the 30-year. So let's do this. Let's take it from here, from there, peak B, failure, and bring it down. And you'll see that right there. We are right on the cusp of at least the shorter term trends. The weekly charts are shorter term. It actually means quite a number of months, almost half the year. But if the 30-year starts to break from 24.23, this is the yield, and it actually goes to 24.90, 25. Let's call it 25. All of a sudden, you've got a very powerful leg B to the upside. You've got a very powerful leg C in the 10-year, which would have broken, it's almost going to break the trend line resistance. And the 5-year will be probably, let me move that away. Yeah, it's very close to starting leg C. Leg C starts in the 5-year 12.42, and the high so far is 12.36. Could happen today. So that's why I'm saying that it is important to look at the bonds, but I think the competition for lower yields, the fact that the market's pulling back now, the Fed is very afraid to go against that kind of trend. And if you're looking at what happens with the higher yields, you can see it right here. The Wood, W-O-O-D, iShares Global Timber and Forestry ETF, started to indicate that maybe that's going to be a peak F right shoulder failure, a right arm extension failure. The Philadelphia Housing Sector Index, the weekly, has made a peak D and is pulling back. It's about to break its important trend line. It's at 236 right now. It goes to 232. It's broken that trend line, uptrend line. So this is really very important all around. And I suggest to you that it's a time for caution. If you have stocks that have done well, this is the time just to raise the stop. In fact, I don't know if I'd even raise the stop. What I would do is right now, I'd take just a little bit off to reward yourself for being correct, and I'd start placing mental stops. Now, sometimes you place the stops, but you also have to look at it and say, these are stops but I've done very well. It's handled the market beautifully up until now. These are stocks that if you've got good profits in. Therefore, I've also got to look at where would I buy? Am I about to put a stop in at the exact point where I'd like to add? So that's going to make it difficult, because if it breaks that level, then all of a sudden you're getting out lower than you would have before. That's why I'm saying, because I've got, well, my indicators are suggesting this market is in for a little bit deeper consolidation than we've seen before. They're going to try to rotate it, and how they rotate is going to be important. But the fact that we've given back all the gains from the other day, that 400-point up move, sorry, the 400-point down move, and then the spike up, and now we're back to where we were at Friday's close. We're down at 18,065. We're lower than the 10,085. Philadelphia Housing Sector Index, it's really important. A couple of things, I had a couple of questions, and Kevin wanted to look at IBB. So let me do this. IBB is trading down 6 at 280.99. The weekly chart, MACD is still holding quite well. That's the reason why I keep saying that my thinking is that fund managers are still treating it as a place to be, even if it's mostly for counter-trend rallies. But my longer term says that even with using Chapman wave together with Elliott wave, we should get a 5 that smashes the 240.03 support at some point, and my target is 220 to 200, somewhere around there. That's number one. Number two is the trading band is still in place. It did go lower than that yesterday, but then it ran back up again. So the trading band suggests that in the 287 area to 289, no, 288 to 286 area is where it's worked to be a short. And then when it comes back into 277, 276 area, so far it's worked to play the upside. But if you're looking at a bigger trend, then the LABD, which is 3 times short the IBB, is probably not the right instrument. I would go with the BIS, the 2 times, which seems to hold its value a little bit better. That's the way I would trade it. So I just wanted to say to Kevin, you're fine for now. And even if there's this bounce that I'm anticipating, which could surprise everyone, it could only be just maybe 9 points or so in the S&P futures, but it might not even translate into that in the cash. And then you've got to be careful, because then we could move down even further. So all I'm saying is, if you're in the position, hold the position. I'd probably get a little bit concerned on the LABD. I'm looking at it right now. If it got back, it's at 21.95. If it started to trade back into the 21.22 area, I'd say, oh man. But if you got in nicely and you're making a nice profit, I'm going to suggest that you don't lose money on this, no matter what. Don't hold it saying, oh, I think it's going lower, I'm prepared to put up with a 2-point loss. No, you can always get back in. Not only that, you can even get back in on a day like this by buying at the high if you feel that the IBB is now finally failing. So, and I think it is. This move down of 6 points after trying its best to hold and having a fantastic day yesterday. My suggestion to you is that if you can hold the LABD position, that's great. But looking out, I'd say the next time, if you don't get the move that continues in the LAB into the 2230s, this is the Direction Shares Daily S&P Biotech Bear 3 times, and you go to the front page of TFNN, there's a whole bunch that you can read up about it, then you might want to be thinking more along the BIS lines. Okay? So let's see, questions away. Yeah, so there was a question about, here's a nice question. Let's see. The question was, Basil, P asks, Basil, your trend works most often. That is clear. How often does it fail when the market is going down percentage-wise, please? So I'm just going to show you this, and I'm just going to say that the 2-day rule is the prices on the upside, and the 1-day rule for the Dow, that applies to the S&P futures and the S&P on the upside, and today's high in the trend was 4.68. Yesterday, I didn't even know that there was a trend. It was down, I mean, the day before on the 400-point move, it barely budged. It had a high of 1 point, what was that high? The high was 1.74. And then yesterday it was down 0.35, and today it's at 4.68. So just let me do this quickly. I've X'd out. I've got a red line through when the technique failed. It failed right there on the 29th of June, because the next day I think the market did pull back, but the Dow never went 1 penny to minus. It's all it needs to go to 1 penny minus, and that's a successful thing. Because 1 penny to down 240, but it needs to go down. And it did. It ran up, and then it came back down, but it never went negative. And on the 8th of July, it had a big spike and then a huge pullback, but it still held plus 28 before it went higher. So that was a failure because the Dow did not go negative, and that's the rule. So out of all these days, this is just what I'm showing you. Let me squeeze it. Out of all these days, those are the two that it missed. There was one that might have happened before that I think I forgot to X out, because there's one that the Dow was up 180 or 230 points, and then it came all the way back down to like a plus 30 or plus 20, and then it closed up plus 50. I had to take, even though it did everything that we discussed, it didn't go negative. All right, so that's that. And now what I'm looking at is I'm going to get rid of this, put it back where it's supposed to be, and this will be for tomorrow's newsletter. I'll have, see, there's a section that I have every day right here. Let me show you. The section is right, no, yeah, right there. So this is what I have every day. Market overview of market today. Right, my final, I talked about the single leg A, I talked about the VIX, I talked about everything. And then I said, today, any early weakness that cannot get the Dow and S&P or the Qs into plus territory, but the Dow is holding minus 60s at noon Eastern time, will suggest Monday was just a bounce. That's what I'm staying with. And then all these different charts. This is just, once again, Chapman Wave. You look for the most identifiable low bar, and you merely count each successive alphabet letter in sequence to the upside, A, B, C, D. When you get to D, other things can happen, even the thing that I call the Chapman Wave instant restart. But D is what you got to be careful. You got to be careful when you get to the fourth highest thing. Then I was asked about BIP. 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 BIP is Brookfield Infra Partners. So I had done this on the weekly. It made a peak D. It's pulling back. And the question was, Basil, where is support on BIP? Where would be a good entry point? Thanks. And my answer was, can I find my answer? Anybody that remember where was my? Thanks, Basil. Right. Well, my answer was something to the point of, I can't remember it because it was something I made up. I didn't have any technical tools. There it is. October the 18th at 2 p.m., around 44 to the 42s. So that's my target. Somewhere in middle of October, I think it's going to hit the 44, 42s. That's going to be the big test. Does it want to break the low of the week of the 1st of July at 41.68 and then head for 39.09, the 200-period moving average? Or is that going to be a fabulous bouncing place that starts the next move up in the weekly, if this is new leg A and not some kind of alternate count? So far, the monthly chart is still very strong. That's BIP at 46.75, down $1.08. Basil Chapman, Tiger Conditions Hour. We'll be right back. And let me just show this chart as we're going out. This is there we are. Okay, so it broke that support. Now we're in ABC, G/C. I'll be back.
My name is Steve Rhodes, author of Mastering Probability and host of the Trader's Edge Show, heard daily here at TFNN.com. On Wednesday, September 14th at 5 p.m., I'll be hosting a special one-hour event, The Ultimate Reversal Patterns. I'll teach subscribers how to identify and trade market tops and bottoms. You'll learn Tom DeMark's TD Setup, TD Sequential, and TD Combo. Plus, I'll show you how to identify Gartley buy and sell patterns, which means you'll learn how to master the D point of any A to B equals CD pattern. More importantly, I'll teach you the most powerful pattern of all by price relative strength divergence pattern. These patterns work for stocks, for ETFs, future contracts, currencies, and these patterns work on every time frame. By signing up for Mastering Probability right now, you get the first month of my newsletter service for only $49, and that includes Wednesday's Ultimate Reversal Patterns webinar. This $49 offer is only good through September 14th, so act now. At only $49 for your first month, I guarantee this is an investment that you won't regret. For all the details of the upcoming workshop and reserve your seat today, visit the front page of TFNN.com now.
In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors. TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
Learn how to trade options with Swim Lessons. Brought to you by TD Ameritrade. Think or swim. Next on TFNN.
Hi, folks. Yeah. Today's, what is today? Tuesday? Yep, Tuesday. Great program all the way through. And, of course, you've got Steve Rhodes' webinar coming up tomorrow night. He always has just really insightful techniques that he's been working on. And the other thing is you've got Thursday, you've got all the way to, you've got your commodities hour. And that's going to be, Andy, that should be very good. So, yeah, asking about the E-mini December contract, I haven't notated it. I will in the next day or two. I just still use things until the little sign says, change. And then I change. So this is the same thing. Look at that big red candle. At any point you could get a bounce, but boy, this is not good looking. And how does the technique work? The sandwich technique. It says that if you close below the important low on the left side, and in this case 2100.25, it confirms the trend remains in a downtrend in this case. Hope that helps you. And let me see. I got a couple of questions. I just wanted to see. Oh, REITs. So you've got the IYR. IYR looks terrible. Peak D in the weekly chart. Peak, what is it in the daily? I've got a Peak G. So this is just saying that the is at 79.22 down $1.61. This point, the 78.87 area, the 200-period moving average is going to be quite key in the daily. But my eye says that the real thing to watch is that low that was made in July, the first week of July at 77.68. That's going to be key for me. I think there's a potential that just like bonds, there's an alternate count that says it isn't a brand new A, it's an F in the monthly chart. And if that's the case, that is a serious high that I've got to take into consideration when my belief is that we're still going to go to higher highs in the next phase of the coda. That this is just an important, this has the potential to be the same as April, May of 1929, going on a weekly, not a daily basis, but on a weekly basis. I'll do a little bit of work if I can over the next few days. Maybe by the weekend I'll have it down to give the relationships let's just see what happens. If the Dow breaks 17,900, then I can start to consider this is the equivalent of that particular period. So 14 to 18% would not be unrealistic. Let's just see what happens one step at a time. So that's the IYR, and the other thing was the XLU. XLU is the utilities peak D in the weekly, and that is a peak D, a brand new, no, it's not. Oh, that's the alternative count, A, B, C, D. Oh, man, this is the same thing in the utilities. Most importantly, at 48.72, down 60. All I can say is that if 46.50, let's make it 46.50 is taken out on a closing basis in the weekly chart of the XLU, the S&P utilities, be careful. Okay, so now I've got that flashing, and within the next 2 days, it could come from a low. It doesn't say it just has to happen right away. It says that sometimes it's overnight. You get a 7 to 11 point rally, and that transfers into some positive action. And it's in the S&P futures, this particular index, Chapman Wave Trend Gauge. But in this case, it's saying that it could come from lower down. We just get very oversold on a very short-term basis, and we have another big pop. That's like 60 points in the Dow, 8 or 9 points in the S&P, and then it starts to pull back again. So just be careful. If you start your short now, this is where there's most risk. That's all I'm saying. There might be a better opportunity. Rather look for good opportunity than say, I've got to do it now, because if it works, it's great. But what happens if it fails? So be careful. The VIX at 18.38 by the end of the day. If it's up in the near 19, this mark is going to add another 80 to 100 points to the downside. But if it suddenly has that chin gauge acting today instead of tomorrow, that could give a pullback, and the trend, the VIX at 17.80 says, hey, now we can just go down to minus 160 on the Dow and maybe just minus 22 on the S&P. Let's see what happens. As far as I'm concerned, the sell mode is in. We're staying on the sell side, and that's just the way it is. Hey, folks, stay tuned. You've got great programming today. I'll be back with an interview later this afternoon. Otherwise, have a great day. I'll see you tomorrow. Oh, and check out my opening call.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
This is TFNN.